Hello, Fast Graph subscribers. I'm Chuck Carnevale, co-founder, and what I really want to do is welcome you to Fast Graphs, and I want to share with you this orientation video, if you will, to kind of get you oriented to how Fast Graphs can help you make better, long-term, sounder, and hopefully more profitable investment decisions. And so I'm going to kind of title this The Features, Advantages, and Benefits of the Core Fast Graph, the actual historical Fast Graph. And what I want to show you here is just some of the features, as I mentioned, some of the advantages, some of the benefits, but I want to focus on the point that we always like to promote and explain to you that this is a tool to think with, okay? It helps you analyze the stock and really organize essential fundamentals at a glance. And it's a very, very dynamic tool. It's also why we call it a tool to think with. You can learn a great deal about the company that you're researching by using the Fast Graph tool, and it can give you an instantaneous impression and insight into the company without having to spend hours going over financial statements or balance sheets and, going through comprehensive research reports and everything. It's a very efficient way to research a stock. So I'm going to orient you to some of the features, some of the advantages, and some of the benefits of the tool, and kind of talk a little bit how to use the tool and how to think about the tool as you're using it. So, we're going to go cover a lot today, but it's an overall orientation to the tool that you've subscribed to. And hopefully when this is all done, you'll agree with me when I say I couldn't even imagine investing in stocks without the perspective and advantages that the Fast Graph research tool does provide me. So thanks for subscribing, and let's go ahead and get into the tool. So first of all, I'm going to start out by using Raymond James Financial here. And I want to just kind of address some of the features of the tool and bring it to your attention. Over here in the graph key, this is a very important part of utilizing the tool correctly. It gives you the growth rate, the multiple of the orange line, which I call the valuation reference line. This is a line that allows you to test in the real world conditions whether or not, this is a good or effective valuation reference or not. And then we're going to also talk about the normal PE ratio, which will be a blue line on this graph when I bring it in, because it is how the market has been valuing the stock over whatever time frame you're looking at. And I want to make that point. We go up to 20 years of historical data, as you can see here. The light shaded areas and the broken line areas represent forecasts. The dark shaded and solid lines represent good historical data. And here I'm looking at adjusted operating earnings. This metric tab here gives you the ability to look at different types of earnings, basic and diluted, or diluted would be GAAP. You also can look at different cash flow iterations and other metrics like EBITDA, EBIT, and even sales, and look at price to sales. So it gives you the ability to look at a lot of fundamentals. But what I want you to do is see what the design of the tool is. Okay, so first of all, we plot the companies. In this case, I'm using adjusted operating earnings. We plot the company's earnings per share over each year as reported on their financial reports. Okay, and then we use a formula, and we have three formulas. Okay, we have the PE equals growth rate formula. That would be this formula. We use that for fast-growing companies. We have a Graham-Dodd formula, a pure Graham-Dodd, sort of modified a little bit by our own algorithms, that really looks at slower growing companies. And then we have this extrapolated formula, the GDF Graham-Dodd formula, P equals growth rate, is when we're looking at companies that grow between 5 and 15%. And we really label 15% as high growth. That's where the P equals growth rate comes in, made famous by Peter Lynch. But then we calculate the earnings growth rate from point A to point B. So in Raymond James Financial, going back to the beginning of 2001, the beginning of their fiscal year, which is September, by the way, and we list the fiscal year here at the bottom of the graph, Raymond James, including forecasts for the next couple of years, has grown operating earnings at 12.81%. Now, if I shorten the time frame a little bit, I want you to notice that growth rate changes. I'll shorten it again to 15 years, and now we get a 17.8%. Now, when that happens, I notice that the formula shifted to P equals growth rate, because we now have growth over 15%. And notice that the multiple that the line is being drawn with is equal to the growth rate as calculated. Now, as you go through that, now we're using a 16 times earnings, but we're using the same formula. And then again, when I go out to max, the growth rate is actually slower or lower on the long term. More recently, the growth rate has been accelerating, as I've illustrated here. And so you use different growth rates, having the ability to see those. Now, what's really important is it's more important to look at the more recent growth rates, in my opinion, than the long-term historical growth rates, because you want to see if the company's growth accelerating, decelerating, or staying the same. Now, the next thing I want to point out before I draw any more on the graph is that the price of a stock will be driven by the operating results of the company. In other words, said simply, price follows earnings. So I'm going to put weekly closing stock prices on the graph right down here in your navigation bar here. I'm going to go ahead and click the word price. And now we've added weekly closing stock prices. And you can see beyond a shadow of a doubt that this 15 times earnings for this long-term historical graph has really been a very strong proxy for a fair value that you as an investor should be paying for this stock. It's less optimum when it's above that, and it's more optimum when it's below that. But anything within this range, of a 15, you could say 14 to 17, you could say 10 to 20, just depending on how lenient you want to be with that. But the key is to analyze that. And clearly, during this time, we see that the 15 PE ratio really gives me a really solid long-term proxy for valuation. Notice that the normal PE is essentially the same number. It's slightly less than 15. It's 14.77. So if I add the normal PE, you can see that I've drawn a blue line on the graph. And so now we're simply saying that the market has valued this at around that 15 fair value reference line. But I can look at that, but I can also point to these different prices. When it's below the line, I can see that the PE is less. And when the price is above the line, I can see that the PE ratio tends to be higher. And of course, when it's touching the line perfectly, I can see that the PE is equal to what the orange line is drawn at. So I get to basically see how the operating results in the company performed. Once again, I'm going to shorten this to a 15 PE. And now I want you to notice that we're drawing a 17.8 fair value for this time frame. But I want you to notice that the market has kind of stuck with that 14 to 15 PE ratio. And keep in mind, this number tells you what the line's drawn at, but by analyzing the line, you can evaluate for yourself how often that line is really applied. And you can see for most of the time frame, going up here through 2018, the stock actually traded at a higher or a premium valuation. And we can see, coming down here at 2018 and 19, even when we had a weakness in earnings, where we had a 17% drop in earnings, that the price dropped. And we've been trading again at that 14 or 15 PE. All that is information. The next thing we do on the graph is we draw a third line, which is the white line, which is, we call it the Dividend POR or Payout Ratio Line. What this line does is it shows, first of all, that the dividends have been increasing steadily. You can see that by looking at the bottom of the graph here. And you can also see that the area below the white line represents the dividend payout ratio. So if I point to one of the dots, I can see that in 2014, fiscal 2014, Raymond James paid out about 18 to 19% of their earnings. When earnings fell in 2020, they paid out almost 24% of their earnings. But you can see that this is really clearly a function of the amount of these total earnings that the company is paying out as a shareholder. Now, we also then take those dividends and stack them on top of the graph to illustrate the very strong point that you get capital appreciation where the price goes from point A to point B, but you also get this dividend income. So if I pick the period here, I'm going to pick 15 times earnings, or as close to it as I can get. And I'm going to end here at, as close to 15 times earnings as I can get. And I want you to notice that we have a 17.8% growth rate. The rate of return, this isn't the full time frame here. I'm in between this full 17.8% growth rate. I've got about a 16.1% capital appreciation return. In other words, the stock has grown pretty much consistently with the growth. But I get a higher growth rate because I also received the dividend income. In this case, based on a $10,000 investment, the dividend income would have been $4,157, and my total annualized rate of return would have been 16.8%, which is very, very consistent with how the company grows, adjusted by valuations. Now, as I change time frames and I get different periods of time here, if I'm using here a 16 PE by pointing my mouse, you can run these calculations beautifully on the fast graph tool. So there I've got it at about a 16 PE, which is right at what the growth rate of the company is. So if I come out here and then hit this, I've got a 14.5, so 14.6. There's a 15.5. That's pretty close. I now get a 17% rate of return. I get 16.4, which is almost identical to the growth rate. So the point is, by buying stocks in value, it gives you the ability to participate to the full measure of the company in terms of growth, but then you also get to receive any dividend income the company does. And notice how the formulas have changed as I change these different time frames when appropriate. Okay, so let's go and look at another company here and look at one that can just give you some more insights. Let's look at AmerisourceBergen. Okay, AmerisourceBergen, just like Raymond James, you can see that the stock price has tracked earnings. And when I measure fair value, which would be on the orange or blue line, when I do that, you're going to see that I get rates of return that are very consistent with what the growth of the company has, and then plus dividend income if the company pays any. But again, if I change time frames, I can, get different views of the company. And this time frame, we're looking at a 13% growth rate. So here we're using the extrapolated. So I've got basically 15 PE ratios, both normal and, other drawn. But again, that's a reference line. Okay, I want to emphasize that's a reference line. You can clearly see that there was a period of time here where the market valued this at a higher valuation in 15. And you can also see that this would have been a less than optimal time to be investing in the company over the next forward years. Your rate of return would have actually been negative, including dividend income, because you overpaid for the stock. Fast graphs not only allows you to see that, but allows you to calculate that. You can also see that if I shorten the time frame here and I'll shorten it even more. If I get some, a good growth phase here where I've got 11% growth and I can buy the company at a discount to the fair value, I can get a 21% rate of return because I included some PE ratio expansion in my calculation on top of the full measure of growth plus the dividend income. So fast graphs gives you the ability to see those kind of perspectives. Now let's go ahead and look at a low growth company, because I also want to make another point. If I look at Campbell Soup here, Campbell Soup long-term has been less than a 4% grower. Okay, so it should be no surprise to you that when I calculate performance, the capital appreciation part of Campbell Soups is right at that 3.95, 3.8%, just adjusted for some little bit of PE anomalies here. But the point is, fair value allows you to fully participate in the growth of the company. But your rate of return is going to be determined by buying the company at value, above value, or below value, coupled with the growth. And that's part of what fast graphs gives you to do. But you can see here that you don't want to overpay for a slow growing company, because you can really get, long-term rates of return, including dividend income, that is very, very weak. But on the other hand, if you even find a slow grower and can buy it inexpensively, you can end up with a moderately decent 7% rate of return by doing that. But once again, I want you to notice I can look at this graph and instantly see that the company pays out 40 or 50% of their dividend. You can see they're paying out about half of their earnings here. Okay, that becomes very clear. Their dividend yield is 3.13%. So you get a chance to analyze all that and look at it. So you're getting a whole lot of information here by looking at the fast graph. And, with slower growing companies, we're using the Graham-Dodd formula. I want to remind you again, but it really gives you insight into what the kind of company is that you're evaluating. Now, if you look at a company like Philip Morris or Altria, I keep calling it Philip Morris because that's the symbol used to be MO when it was Philip Morris. Here we got about an 8% grower, got a fair value reference line of 15. You can see that line, there are times when the market overprices it and underprices it. But again, the price goes where the earnings go. And, if I hit these things when the valuations are in line, I get a rate of return that's going to be very close to what the company generated. Plus, though, I get the dividend income. But I also want you to notice, just by looking at this graph very quickly, I can see that this company is paying out the vast majority of its earnings to their shareholders. 75 to 80% of the earnings are being paid out. That's why the light green shaded area is so thick and the white line is so high here. Their dividends have increased every year. And, the dividend has grown pretty well consistent with the growth rate of the company, but I see that immediately by looking at the company. Now, again, if I go back into, let's say, a slow growth company like a utility, I'll use Edison International here, which doesn't have much growth. If I shorten the time frame, you can see they've grown about 2% a year. Once again, I'm going to get a decent dividend income here of over 4%, and it's paid out a pretty, half of its, pretty good portion of its earnings. But again, you don't want to overpay for slow growth, and the fast graph really illustrates that, because your rates of return will be anemic, less than 0.5% over a 4 or 5 year period. But even if you buy this stock at fair value, you've got to recognize your capital appreciation is going to be relatively mild. It's going to be consistent with the growth. Now here, I'm getting PE ratio expansion. You can do all these marvelous things with the fast graph. Now, a couple of other things I want to show you in this first preliminary video. If I look at a company that's been under a lot of stress lately, like General Electric, and I look at General Electric over a long period of time, I can see here that if I'd have bought General Electric back in 2002, right at its peak, and held it to where it was still in fair value in 2020, I'd have lost an average of 4% annualized on my money, and that includes dividends. My actual capital depreciation would have been 10% a year, but only because they did pay some dividends. But I also want you to notice some other things that you instantly see by looking at this graph. You see that, they cut their dividend in 2009 and 2010. And then they grew it again, and you can see they slashed it again, and then they completely eliminated it virtually, or almost eliminated it, going into these future years here. And now we're seeing a recovery. So historically, this has been a very poor investment. You certainly don't want to buy and hold this. Now, whether or not it's a good buy today or not is something that I'm not going to get into in this video, because I'm looking at historical, but that's something we would look at when we're looking at the future. Another good example of this is how you can see how fast graphs can help you instantly recognize a company. If you look at a stock like Bed Bath & On, you can see how important the operating results of the company have been to the stock price. And, you can also see that at times the market gets either really aggressive or really depressed, I guess you might say, or really negative on a stock. And that can happen very, very quickly. But the tool gives you the ability to see all these things and evaluate them. And again, I want to be very clear when I'm looking at this here and showing you this. You can look at companies. You can see a company like Eastman Chemical, for example, is moderately cyclical, but it does have a really solid dividend record. Okay, and pays 3.7% because it's very inexpensive today. So, all the times to buy a stock would be when it's cheap. Even a cyclical stock like Eastman Chemical, when you buy it when it's inexpensive, even if the company's inexpensive today, you can still generate very high rates of return. If you buy it when it's inexpensive and watch it get, at a premium valuation, you can make really exceptional rates of return. But fast graphs allows you to see this kind of thing almost instantly just by looking at the company. Now, there are exceptions to every rule. You can look at a company like the great Amazon, for example, and I got to shorten the time frame so I get some growth. And you can see that their earnings, that there's not a real good correlation between earnings and the stock price. But I can use other metrics. I can look at operating cash flow and find out that Amazon has been trading very consistently at about just under 30, or we can call it 30 times operating cash flow, 25 to 30 times operating cash flow. And the stock's trading at 23 times operating cash flow now. So on a historical basis, it would be inexpensive. But again, forecasting would be a different matter, or could be a different matter. But once again, you can see that. And again, if I change the time frames, you can see that this company has continued to grow at 25 to 30% a year. And you can see how the stock price has tracked that. So it just gives you so much insight into the company just using the regular, this is the old regular fast graph itself is what we're looking at. Looking at some other examples here that you might find interesting If I look at a company like, and this is what I was asked for, like Scott's Miracle-Gro, you see some really interesting things here. Number one, you see where the company paid these special dividends. They paid an $8 special dividend in fiscal 07, which again was a September year. And you can see they paid a, $2 or $3, we'd have to look, but they paid a special dividend there. You can see that by just looking at the graph. You can also see again how the company's stock price tracks the operating results of the company, and how the operating results spiked, how the stock price spiked, and then when the operating results collapsed, the stock prices collapsed. So you then would have to make a decision, is this the kind of company you want to look at? Now here I'm looking at cash flows. You can see a similar situation with earnings, okay? The company stock price is going to track its operating results, whether it be cash flow or earnings or whatever, and you can see that, how the company has behaved, but it also kind of explains how this massive drop. I could argue that the company got overvalued in, the spring of 2021, and now in the fall of 2022, it's now maybe fairly valued or getting into undervalued territory, beginning to. But again, you've got to decide by looking at this whether or not this is a stock you'd want to own or not. Growth rate is 7%. If I use the scroll bar, when it peaked, it got up to 11%. But normally the growth rate has been around the 7% range, and the stock price, as you can see, have tracked that. So these are insights that no other tool that I know of, no other research tool that I know of is capable of giving you. And that's something that the Fast Graphs does. And even if I look at the mighty Apple here, if you use this tool correctly, if I use Apple over a 20-year period, the company grew at 36% a year, but the market valued it around 22 times earnings, and actually less than that for a significant part of the time. There was a time you could buy Apple at 10, 12, 13, 14 times earnings. It currently trades at 25 times earnings. But if I change these time frames, now I've got 13% growth, 12.94, and I can see that, the company's really gotten expensive here, but I can also see this surge in earnings growth here that can partially explain the enthusiasm. But then if I'm looking forward, I'm seeing that analysts expect growth to slow down again. So if I shorten the time frame, I get a totally different growth rate. If I get rid of that 70% growth rate, we're only looking at 5 or 6% for Apple going forward. If the analysts are correct, that could change your opinion of whether or not you think Apple's a good buy. Clearly, it was a great buy back here when it was trading at 10 multiples. It's, questionable whether it's such a good buy here. Now, it might have been a great hold, but whether it's a good buy or not, it's a whole totally different question. So there's a lot of things that you can do with Fast Graphs that you can't do with any other service that I know of. Again, it gives you the ability to look at these things and very instantly say, here's non-dividend paying stock AutoZone. It's growing at 15 to 20% a year, 18.19. The stock price tracked that. And again, if I click on, the PE ratios, you can see that I'm getting performance that's going to be very close to what the company generated. That's what value investing is all about. And you want to be careful with that, because if you're investing in stocks and you really like the company, like this is Medtronic, and the market's overvaluing it, you could go into a long lost decade here or more of a company that actually grew very well. In fact, if I, kind of scroll back here, this was a time when the company was growing at about 11% a year, but because you would have overpaid for it, and I'm just picking times here, you'd have ended up making almost nothing on your money, because valuation matters and matters a lot. And that's what this is. It's a valuation tool. But I want to end this by saying it's a tool to think with. So you can look at all these scenarios, but study the charts. Don't just automatically look at the picture. Run different time frames. Play with the tool. Make sure you know what you're looking at when you're looking at a graph at a certain time frame. Check the fast facts boxes. Use this tool effectively. It can really help you make better long-term investment decisions. I hope you enjoyed this introductory tutorial into the features, advantages, and benefits of Fast Graphs. We're going to be doing a lot more tutorials looking at a lot of the other features of Fast Graphs, like the forecasting calculators, the analyst scorecard, the portfolio sections, and so on. We're going to be talking to you about a lot of other features of the tool, but this was just one to get you started in looking at the basic Fast Graphs. Anyway, this has been Chuck Carnevale, co-founder. I really appreciate you being an investor. There's a lot of features we're going to be adding to the tool in the forthcoming months. So a lot to keep in mind, keep your eye out for some of the new announcements we make. And when we make the announcement, if we go back to the chart for a moment, we list those announcements up here. If you just click on the bell, it gives you what we call our updates. You've got your what's new on fast graphs, and it'll be showing you. So keep your eye out for that. We'll alert you when there's a new release or something announced. Anyway, I want to welcome you again for being a subscriber. I hope this helps you get a little better oriented to the graph. I know it's been a long video, but there's so much to this tool that we haven't even begun to look at yet. I think, again, as I say all the time, I wouldn't even consider investing in stocks without the perspective that fast graphs gives me. Thanks for watching. We'll be talking to you again real soon.